On July 14, 2026, $65 billion of market capitalization just evaporated. Gone in a single pre-market trading session. This wasn't some slow, gradual bleed. It was a violent, structural repricing of one of the world's most entrenched technology companies. Now, the headline catalyst was a second-quarter earnings pre-announcement that missed Wall Street's expectations. But the underlying reality? It's far more dangerous. That crash exposed a deep, structural anxiety that is absolutely terrifying institutional investors. We're talking about a hidden artificial intelligence threat that could fundamentally disintermediate the company's highest margin software revenue. So the central tension we are unpacking in this explainer is exactly this. Is this $65 billion wipeout a generational buying opportunity for a misunderstood turnaround? Or are we looking at the very first crack in a terminal decline?
Hit with a staggering 23% single-day drop, the stock plummeted to just over $220 a share. That move completely erased a powerful rally that had pushed the stock near 300 just weeks prior. I mean, a percentage drop of that magnitude is just shocking for a legacy blue-chip giant historically known for stability and steady dividends. But what's really interesting here isn't just the drop itself, it's what that number represents. A drop like this implies the market suddenly woke up and realized its fundamental thesis was flawed. Investors aren't just reacting to a delayed sales cycle anymore. They're reacting to the sudden, very real possibility that enterprise clients have found a new way of operating, one that completely bypasses legacy software vendors. But to really understand exactly what broke, we first have to understand how this company actually makes its money today.
So let's look at the economic engine. What is actually driving this business?
To grasp the severity of that July crash, you have to look past the outdated perception of this company as just some legacy hardware manufacturer. Over the last several years under CEO Arvind Krishna, they have ruthlessly pivoted. They spun off their managed infrastructure services business and totally transformed their core identity. Today, this is a globally integrated technology and consulting firm architected around high-margin software, hybrid cloud environments, and enterprise AI. Just look at this breakdown of their $67.5 billion in fiscal year 2025 revenue. It tells the real story. Software is the primary economic engine now, contributing roughly 45% of total revenue. And here is the kicker. That software segment commands massive, near 83% gross margins. We're talking about their Red Hat hybrid cloud platform, automation tools, and the Watson X AI data platform. Then you've got consulting at 31.3% of revenue, employing over 160,000 specialists worldwide to help massive corporations modernize their systems. And finally, there's the legacy infrastructure segment at 23.3%, which houses the highly cyclical but incredibly sticky IBM Z mainframe computers. So, the bottom line is, they make their real money selling high-margin software, and then they leverage a massive consulting arm to embed that software deeply into enterprise operations.
But here is where their strategic positioning gets really fascinating. They aren't out there trying to beat Amazon Web Services, Microsoft Azure, or Google Cloud at their own game. Instead of competing as a commodity public cloud utility, they've positioned themselves as a neutral software and orchestration layer. Think about it. When a massive, highly regulated bank or healthcare network transitions to the cloud, they rarely want to be locked into just one single provider. They want their applications to run seamlessly across AWS, on-premise servers, and private clouds. By controlling Red Hat OpenShift, which is the industry's leading enterprise Kubernetes platform, essentially the software managing these massive cloud applications, this company provides the open abstraction layer that makes multi-cloud a reality. They aren't the cloud, they are the neutral toll bridge connecting all the clouds.
And that unique positioning builds into their foundational defense. They operate with three core competitive moats. First, incredibly high enterprise switching costs. The absolute core of global financial systems, payment processing, and transit networks still run on their Z mainframe architectures. Ripping those deeply integrated mission-critical systems out, that represents massive execution risk and disruption for any client. Second is that Red Hat ecosystem advantage we just talked about, which embeds them directly into those hyperscaler environments. And third, their global consulting distribution scale. Smaller, nimble software competitors just do not have the 160,000 professional consultants required to manage complex integrations of legacy on-premise code with modern cloud environments. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. It's this exact combination of embedded hardware, neutral software, and massive deployment scale that the market assumed was completely impenetrable.
Which brings us to the central conflict and the market's deepest fear.
If the moats are so deep and those software margins are so high, what on earth triggered a 23% collapse? To answer that, we have to look at the massive disconnect between what management said happened and what the institutional market fears is actually happening. In that preliminary July 14th release, CEO Arvind Krishna offered 3 very specific reasons for the sudden revenue miss. He stated that enterprise clients shifted their IT capital expenditures away from software and toward physical servers and memory, essentially trying to front-run anticipated supply chain price hikes. He also noted that industry-wide cybersecurity challenges distracted corporate purchasing officers, and finally, he admitted to an internal execution failure. Sales teams simply failed to close large, late-stage software deals before the quarter ended. Now, that official excuse paints a picture of cyclical, temporary headwinds. It actually makes the bear case feel intelligent but manageable, right? Just hardware squeezing discretionary software budgets for a quarter or two. But the market absolutely did not buy that this was just a temporary delay.
The market sold off $65 billion because of this, the hidden AI disintermediation threat. The true structural fear hiding right beneath the surface of that earnings miss is that enterprise clients are beginning to utilize generative AI to write custom code and completely bypass legacy software vendors. For decades, companies had absolutely no choice but to pay exorbitant recurring licensing and maintenance fees for modular software. But generative AI-assisted coding tools are suddenly making it incredibly viable for corporations to just build their own bespoke software engines internally. And we are already seeing this exact threat playing out in action. In mid-2026, Starbucks announced a massive $2 billion turnaround strategy. A core pillar of that strategy, slashing $400 million in software costs. And they aren't just renegotiating contracts, they are actively building custom, in-house AI-powered alternatives to directly replace their Microsoft inventory tracking systems and their IBM equipment maintenance platforms. Starbucks is attempting to eliminate those long-term software licensing costs permanently. So, the existential question terrifying Wall Street is this: if a coffee company can use AI to build its way out of legacy software lock-in, what happens when the massive global banks and healthcare networks decide to do exactly the same thing? The recurring software revenue model that underpins this company's entire valuation could face structural, irreversible erosion.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; and dividend hunters, durable income with the fundamentals to back it up. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of the screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's dive into the evidence and do an autopsy of that July 14 crash. To really figure out whether this is a structural failure or just a cyclical blip, we have to look at the hard financial proof points delivered in that preliminary Q2 2026 earnings pre-announcement. The numbers they announced on July 14 were stark. The company reported total Q2 revenue of $17.2 billion. That was only a 1% year-over-year increase, and it widely missed the consensus analyst estimate of $17.86 billion. Guys, that is a massive $660 million top-line miss. And the bottom line wasn't spared either. Operating non-GAAP diluted earnings per share came in at $2.93, missing the $3.02 expectation by 9 cents. In the enterprise software world, when you miss revenue by over $500 million, analyst downgrades are swift and they are brutal. HSBC downgraded the stock immediately to reduce with a $191 price target, citing deep concerns over structural growth limitations.
When we look at how that pain was distributed across the business segments, the picture gets a lot clearer. Software, their crown jewel and main growth engine, managed to grow 5% year over year, but context is everything here. That is a drastic deceleration from the 11% growth software posted just 3 months earlier in Q1. Consulting completely stalled out, posting 0% growth, remaining totally flat year over year. And infrastructure, driven by a cyclical pause in their Z17 mainframe hardware refresh cycle, suffered a painful 7% decline. Literally every single pillar of the business showed signs of exhaustion simultaneously. Naturally, this deceleration directly impacted profitability. GAAP gross margins compressed by a full percentage point down to 57.7%. Yet incredibly, despite this miss, management did not back down from their aggressive full-year fiscal 2026 targets. They are still guiding for $15.7 billion in free cash flow for the year. Do the math on that.
To hit that target, they have to generate roughly $11 billion in free cash flow in the second half of the year alone. That requires a steep 10% growth acceleration. And at the exact same time margins are compressing, they're launching these massive counteroffensives. They've made a $5 billion commitment to Project Lightwell to secure the open-source software supply chain, and they've got a planned $10 billion plus investment into the Andron Quantum Foundry backed by CHIPS Act incentives. The tension here is immense. They are spending like a high-growth tech startup while reporting decelerating mature company numbers.
Let's synthesize all this into our qualitative scorecard to assess the true underlying business quality. Out of a 10-point scale, their blended score sits at a solid 7.0. Management alignment is a very strong 8 out of 10, largely because CEO Arvind Krishna's compensation is 96% at risk and tied directly to free cash flow generation. Business viability is also highly durable, coming in at an 8 out of 10, protected by those deeply embedded Z17 mainframes acting as the absolute backbone of global banking. Revenue quality sits at a 7, supported by a massive $23.6 billion in annual recurring revenue. But the glaring weakness here, that's financial health. It scores a 6 out of 10 due to a highly restrictive leverage profile, which we're going to unpack shortly. The real narrative this scorecard reveals is one of incredible tension between a highly durable, viable infrastructure on one side and a balance sheet that leaves absolutely zero room for error during this complex transition on the other.
Now let's look at the 5-year valuation scenario framework.
Before we do the math, I must state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. To understand the valuation, we have to understand the operational assumptions required for each case over the next 5 years. Let's start with the low case, representing our bear thesis with a 25% probability. Here, the AI disintermediation threat actually materializes. Clients like Starbucks successfully build custom code, causing widespread contract attrition. Revenue crawls at just a 2% compound annual growth rate, free cash flow margins compress to 16%, and the market assigns a low 12 times multiple. The base case, which we give a 55% probability, assumes the hybrid cloud model holds strong. Red Hat maintains containerization leadership, revenue scales at a 4.5% CAGR to $84 billion, stabilizing cash flow margins at 20% with a historical 15 times multiple. And finally, the high case. This is our bull thesis at a 20% probability. This requires the successful commercialization of Project Lightwell and quantum monetization. Revenue accelerates at an 8% CAGR to nearly $100 billion, margin expands to 23%, and the market rewards them, re-rating the multiple to 18 times free cash flow. Again, if you want to access the full model with all detailed assumptions for each scenario, you can check out the detailed research report at flash.stocksentinel.ai.
When we run that math based on the current post-crash stock price of $220.57, the outputs are really compelling. The low case implies a future price of $152.30, which, even when you factor in their hefty dividend, results in an annualized return of roughly -3%. The base case points to an implied future price of $271.49, generating a solid near 7% annualized return. And if that high case executes perfectly, the implied price rockets to $451.45, offering over a 17% annualized return. When we probability weight these outcomes, the implied target price is $277.68. This perfectly demonstrates how the severe valuation compression following the July crash has created a potentially asymmetric return profile. The upside of the base and high cases heavily outweighs the downside of the bear case, but that's only if the moats hold.
So let's talk about the risks and what could actually break this thesis.
Because the reality is, the moats might not hold. We need a dedicated risk analysis to unpack exactly what could go wrong and completely prevent the base or high-case scenarios from playing out. The most immediate internal risk is sitting right on the balance sheet. The company carries a staggering $66.4 billion in total debt against just $11.8 billion in cash. When you combine that heavy debt load with their commitment to returning $6.3 billion annually in dividends to shareholders, the financial math gets very, very tight. That massive dividend obligation consumes over 40% of their operating cash flow. This debt anchor severely restricts management's capital allocation. They have very little flexibility to pursue aggressive, needle-moving acquisitions or to execute massive share repurchases to defend the stock price if things go south.
Beyond the balance sheet, there are broader systemic and execution risks constantly threatening their mid-single-digit growth narrative. As we've discussed, widespread AI disintermediation remains the absolute existential threat here. If that Starbucks model of building proprietary AI in-house becomes the new enterprise standard, this company's software licensing revenue will structurally decay. Furthermore, their enterprise clients have shown a recent tendency to prioritize cyclical hardware purchases to get ahead of anticipated supply chain constraints, which ends up freezing software budgets in the process. Macroeconomically, with over 50% of their revenue generated globally, rapid foreign exchange volatility can easily wipe out growth on paper. And finally, managing the friction of integrating massive acquisitions like HashiCorp and Red Hat carries immense product alignment and developer attrition risks.
So what should you actually watch for as an investor? Here are the highly specific, decision-useful warning signs to monitor in future earnings reports that would indicate the thesis is structurally breaking. First, watch Red Hat's annual recurring revenue. It accelerated to 11% in Q2. If that software ARR growth drops below 10%, the neutral hybrid cloud thesis is cracking. Second, watch the consulting book-to-bill ratio. If it falls below 1.0x, it means they are burning through their backlog faster than they are winning new business. Third, listen very closely to management commentary regarding contract negotiation cycles. If those average cycles continue to lengthen, it means the Q2 delay wasn't just a blip, it was a permanent change in enterprise purchasing behavior.
Let's wrap this up with the final autopsy and prognosis.
The July 14th crash was a violent reality check, but the investment profile moving forward is really defined by three critical takeaways. First, the technicals are vastly oversold. Second, despite the growth slowdown, the business possesses a massive free cash flow floor. But third, the existential AI disintermediation threat simply cannot be ignored. The market is demanding proof that their high-margin software is immune to internal, AI-driven corporate development. Which leaves us with the ultimate question. Is the AI threat a terminal decline for legacy software vendors? Or has the 23% crash merely created a transitional discount for a fundamentally sound business? The math suggests an asymmetric upside, but again, only if the hybrid cloud moat proves impenetrable to generative AI. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.